It's quiet now. The phones aren't buzzing with alerts. The frantic scrolling through headlines has stopped. And if you're watching this, that quiet probably feels heavy. It's the silence after the storm. January 30th wasn't just a bad day. For a lot of traders, it was a breaking point. Gold and silver didn't just dip. They seemed to fall off a cliff. And if you were caught in that, you're not just looking at a loss on a screen. You're dealing with something deeper, a crack in your confidence, a knot of frustration, maybe even a bit of shame for having fallen for it. We're going to talk about that today, but we're not going to call it a gold crash. That headline is part of the problem. Today, we're going to dissect what I call the volatility trap. We'll look at why this event was so psychologically devastating, how the market's hidden machinery actually works in these moments, and most importantly, we'll walk through a real, structured path to heal and regain your footing. This isn't about a quick fix. It's about understanding the fracture so you can heal stronger than before. Let's start by putting the price action aside for a second. I want to talk about the story, because before January 30th, the story around gold wasn't just bullish, it was beautifully logical. Central banks buying? Check. Geopolitical tension? Check. A hedge against everything? Check. It was a narrative that made perfect, elegant sense. Your brain loves a story like that. It's cohesive. It's tidy. This is the first layer of the trap, the narrative fallacy. We are hardwired to weave disjointed events into a sensible plot. The problem is, the market isn't a novelist. It's a chaotic, living ecosystem. We fell in love with the plot, the great monetary demise, and we confused that compelling story for a sure thing. We weren't just trading a metal, we were betting on a screenplay we helped write in our own heads. And because it felt so obviously true, the second bias kicked in, confirmation bias. Once you're long gold in that environment, what do? You watch videos that explain why $2,500 is a minimum target. You follow analysts who've been bullish for years. You read articles about de-dollarization. Your brain, seeking comfort, acts like a magnet for confirming evidence. Meanwhile, it treats warning signs, like a persistently strong US dollar or extreme overbought readings on the charts, like static. It doesn't just ignore them, it actively discounts them. That old metric doesn't apply anymore, you'd think. This time is different. Then there's the third member of this psychological trinity, recency bias. Our most powerful memories are the most recent ones. For weeks and months, the only muscle memory your trading brain had was by the dip. Every shallow pullback was a gift. The market conditioned you, like training a puppy with treats, to believe that weakness was always a buying opportunity. So when the real selling started, your first instinct wasn't panic. It was, here's my chance to add more. The recent past created a dangerous illusion of predictability. So when the drop came, it wasn't just a loss. It was a total narrative annihilation. The story you trusted, the one that made you feel smart and in the know, was publicly, violently dismantled on the chart. This is why it feels personal. The market didn't just take your money, it made a fool of your judgment. It called your reality a fantasy. That is the core injury. The financial loss hurts, but the psychological blow, the shattered trust in your own analysis, is what causes traders to walk away for good. Now, let's peel back the curtain on what actually happened in the market that day. Understanding this is crucial because it transfers the event from a personal failure to a mechanical process. You weren't victimized by a mysterious force. You were caught in a systemic liquidity event. Picture the market not as a smooth elevator going up and down, but as a series of doors. Behind each door are buyers and sellers providing liquidity, the ability to get in or out easily. In a calm trend, those doors are wide open. But when fear spikes, what's the first thing that happens? The liquidity providers, the market makers, the big banks, they step back. They widen their spreads. They pull their large bids. Why? Because their job isn't to catch a falling knife. It's to manage their own risk. So suddenly, the doors don't just close, they vanish. You're in a hallway with no exits. This creates what's called an air pocket or a liquidity vacuum. The price isn't falling because there's a reasoned, massive reevaluation of gold fundamental value in that instant. It's falling because there are no substantial bids to stop it. The floor is gone. And into this vacuum falls the next piece of machinery, the stop-loss cascade. Thousands of retail traders just like you have their protective stops clustered around the same technical levels. below that key moving average, under last week's low. As price taps those levels, it doesn't find buyers. It finds a pile of automated sell orders. Each triggered stop becomes a new sell order in the market, pushing price lower, which triggers the next cluster of stops. It's a self-feeding, algorithmic fire sale. Then, layer in the unwinding of leverage. Think about the massive long positions in leveraged gold ETFs, or the speculators who were using 10x or 20x margin to ride the trend. For them, a 5% drop isn't a setback, it's a margin call. Their brokers don't ask for their opinion. They forcibly liquidate their positions to cover the loan. This is pure, involuntary selling. It's gasoline on the fire. So let's reframe what happened to you. You didn't simply get stopped out. Your stop-loss order was a tiny piece of fuel thrown into a high-frequency, self-perpetuating liquidity crisis. The market wasn't rejecting gold. It was violently repricing short-term risk and purging excess leverage. You were a casualty of that mechanical process. This understanding is liberating. It wasn't about you. It was about the cold, impersonal physics of a crowded, over-leveraged trade breaking down. Okay, we've named the psychological wounds. We've demystified the market mechanics. Now, how do we heal? This is where most advice fails. They tell you to risk less or be disciplined. That's like telling someone with a broken leg to just walk better. We need a cast. We need rehab. Here is your rehab protocol. Phase 1. The forensic review, without the scalpel of blame. Do not open your trading journal and write, "I'm an idiot." That's useless drama. Instead, conduct a clinical inquest. Ask these questions and write the answers down. 1. What was my core thesis? Was it based on a fundamental narrative, the story, or was it based on a specific price action trigger that aligned with my edge? 2. At what point did the price action invalidate my original thesis? Was it before my stop was hit? Did I ignore that point because the story was too compelling? 3. Did my position size reflect the volatility of the asset or just my conviction in the story? This isn't about guilt. It's about pattern recognition. You're diagnosing a system error, not flagellating a soul. Phase 2. The market reality reset. You must internalize a new core belief. I am not a storyteller. I am a risk manager navigating a complex, probabilistic system. This changes everything. Your primary job is no longer to predict the plot. It's to ensure you survive the volatility. This leads to 3 concrete changes. Position sizing for volatility, not conviction. Your size isn't a vote on how right you are. It's a function of how wrong the market can be while you're still in the game. After a shock like this, you cut your standard size in half. Not because you're scared, but because you're respecting the new, demonstrated volatility environment. Stops based on structure, not pain. Place your stop loss where the market structure breaks, not where your pain threshold is. Is it below a key consolidation zone? Beyond a recent swing low that, if broken, changes the character of the move? This ties your exit to the market's language, not your P&L anxiety. The waiting game. After a volatility explosion, the market is concussed. It needs time to find equilibrium. Your rule is simple. You do not re-enter a trade in the same asset until the daily charts have had at least 5 to 7 sessions of consolidated, quieter price action. You trade the rebuild of stability, not the echo of the panic. Phase 3. The micro-commitment comeback. Your confidence is shattered. You don't rebuild a shattered wall by trying to slam a new one into place. You lay one brick at a time, perfectly. The observation journal. For the next 2 weeks, you are forbidden from placing a live trade in this market. Your only task is to write down 3 objective observations every day. Price is consolidating between X and Y. The 1-hour chart shows lower volatility. No predictions, just observation. This rebuilds your connection to the market's rhythm without the pressure of money. The P&L stress test. This is a brutal but essential exercise. Go through your last year of trades. Find your single biggest winner. Now, delete it from your record. Recalculate your total P&L without it. Are you still profitable? If that one trade, often the one where you rode a narrative trend, is the difference between green and red, then you weren't trading an edge. You were gambling on a story. Seeing this truth is freedom. It tells you exactly what you need to build, a strategy that doesn't depend on home runs. Phase 4, the reframe. This event, as painful as it is not your enemy. It is the most expensive, and therefore most memorable masterclass you will ever take. It has shown you the precise location of your weaknesses, in your psychology, in your risk mechanics. A trader who has never been through this is like a sailor who has only seen calm seas. They have no idea what their boat, or their own stomach, is really made of. You now know. You have been tested. The goal is not to avoid all future storms. The goal is to build a boat and a captain's mindset that can survive them and sail again. This journey, from the narrative high, through the trap, into the autopsy and the rehab, is what separates a losing trader from a resilient one. The losing trader gets defined by the event. The resilient trader is forged by it. Your task this week isn't to make back your money. It's to complete phase 1. Do the forensic review. Write down the answers. That single act of non-emotional scrutiny is the first, most powerful step out of the emotional wreckage. If this resonated with you, if you're ready to do this work, then you're in the right place. This channel, Losing Traders Psychology, is built for this. We don't trade tickers here, we trade mindsets. Hit subscribe and ring that bell. But more importantly, I want you to do one thing for yourself and this community. Go down to the comments and type one word. Just one. The word that best describes the bias that got you. Was it narrative? Confirmation? Recency? Seeing that you weren't alone in this is part of the healing. In the next video, we'll dive deeper into building that volatility resilience system. We'll talk about specific tools to measure market tremors before they become quakes. But until then, be kind to yourself. The market is a brutal teacher, but its lessons, once learned, are yours forever. I'll see you in the next one.